Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds. Our data helps forecast which parts of the market are about to get hot and which equities are likely to blow up in your face. You can subscribe and get cheat sheets delivered to your inbox. Best of all, it's free. Go to stockcheatsheets.substack.com to learn more.
Now, here's today's free update.
Double A, do you think we're in blow up in your face mode yet?
Felt like it today. Thursday, felt like it.
I'm Mike O'Connor. I'm the author of StockCheatSheets.com. You can find me on Substack. And you are?
I am known as Double A, and I'm from macro2mortgage.com.
Double A is also our chartered market technician in training and is the bond expert. So he basically runs his mortgage business like a trader and advises clients about interest rates. And you have an interesting theory about rates that's very contrarian, which we'll get to a little bit later today. We're going to actually, in today's Unfair Advantage Cheat Sheet podcast, we're going to cover some fundamentals, which increasingly concern me. And even though I trade what I see in an intermediate time frame, I do like to keep an eye on the big picture because I think we're starting to see a proliferation of data that's really hard to ignore about stock prices and the relative potential for appreciation in the coming months and years. We do need to have like the completion of the market cycle that maybe the Fed hasn't allowed for a while. So we'll get into that. And then we'll do a quick market and index tailwind evaluation and a relative strength rank and trend report. And finally, I'm going to share with you some new chart indicators that are kind of what I'll call tailwind light. Double A, I know you got a chance to sneak preview them. I'm excited about them. Work in progress.
Yeah, I like what I saw in the sneak peek. Looking forward to see more.
Yeah, I'll share the code with you so you can maybe play around with it too, and tell me what your experience is when you look at it.
Cool.
All right. So before we get into what we normally do as trend following traders, remember we take that portion of our money that is not meant for retirement, for taking care of kids' education. This is our fun money. Now, Double A and I usually take the cheat sheet metrics and apply it to leverage strategies in the options market, but that doesn't mean you have to. The point we should make, though, is since cheat sheets generally supports round trip trades that are under a year, they can be very lucrative and profitable without the long holding periods, but under a year means there are some taxation issues. And there's obviously too many round trips in the same day, which we try to avoid, can get you into trouble with the pattern day trading rules. So when we're trading this narrower time horizon, it's important that the pile of money we're playing with is the money. It's the highest risk capital of everything you do. But I know this is how I fund the lifestyle that I couldn't afford otherwise.
Yeah, it's fun money.
Yeah, I'm going to Panama for 10 days. Now, of course, I haven't been making this money lately because the market's been really cooperating the last 6 or 7 days.
Yeah.
But in general, the first half of the year is what funded my Silver Seas cruise to South America and my trip to Denver to see you for a Red Rocks concert later this
in November.
Flying first class.
Nice.
And this is all thanks to not my genius. I just follow the cheat sheets formula and make trades and share them with you. You can go to stockcheatsheets.com to learn more. All right. That's, I think, enough of a horrible sales pitch. So Double A, there are 6 things that are starting to keep me up at night when I look at the numbers relative to the S&P 500. So since you're the expert here on a lot of this technical and fundamental stuff, why don't you give us a rundown? Let's start with price to earnings ratio. Just let's assume there's some traders that aren't fully versed in the macro side of trading.
No problem. Full disclosure, I'm more of a technical guy than a fundamental guy, but I got you on this.
You need the macro though for your chartered market technician status.
Exactly. So in training, so the PE, price to earnings ratio, basically is a measure of how much an investor is willing to pay for a dollar of forward earnings.
Yeah.
Right. So calculated by dividing the current price by the earnings per share. Higher the PE suggests that the stock is expensive relative to what they're earning. Lower is more desirable.
Yep. So the higher the ratio, the greater that disparity is between the stock price and the earnings. And we're right now looking at an S&P valuation around, or PE number around 27.
It's very
So
high.
that's historically on the high side.
Yeah. Well, I mean, what's the the kind of the mean or the median over the last couple decades? It's high teens, isn't it? 16, 17, something like that.
Yep. And and again, the market generally will exceed that. I can remember 2005 to 2007 trading when the PE multiple was in the low 20s.
Okay.
And so we finally got out of the low 20s and into the high 20s. And that's when we rolled over in the fall of 2007, roughly. And so historically, now the dot-com bubble was much worse. And a lot of folks compare the current rally that we're in to the dot-com bubble. But PE is the first thing that generally gets out of whack when a bubble just before a bubble pops.
Yeah.
Hard to time. All right, so let's tackle this. Professor Shiller's CAPE ratio.
Yeah, this one was a little harder for me to learn. It basically is kind of the same principle, only over a longer period of time, so it smooths it out. So the Shiller P, can't even say his name, also known as the CAPE, it adjusts the traditional PE ratio by averaging earnings over 10 years and then adjusting for inflation. So that basically smooths out any of the short-term ups and downs that may occur.
Yep.
And
so CAPE ratio is 30 right now.
And much like the PE itself, a higher CAPE ratio signals that the underlying is more expensive.
Yep. So we've seen CAPE ratios in the high 20s, 30s, and mid 40s during the dot-com bubble. So we could run appreciably higher before this is a problem. That's why this stuff is impossible to time, but it does just speak to the chances of the next 18 months being like this previous 18 months is quite unlikely based on these extended valuations.
Yeah.
We may be in the middle of a blow up top. Certainly if we blow through this resistance level we're currently at in the market, that's probably the last run before a change.
Yeah.
All right. And this is one of my favorite, price to sales ratio.
Yeah, this one's good because it is more for newer companies, I suppose. So the price to sales ratio, it compares a company's the price of the stock to its revenue per share. So again, it's useful for evaluating companies that may not yet be profitable.
Harder to monkey around with sales figures. Like you can do all sorts of accounting sheets.
Yeah, totally.
When it comes to earnings, but man, your sales are your sales, right?
Right.
Money in. It's hard to fudge that.
It's hard to fudge money in. Yeah.
Right. Although speak to Enron, they figured out a way.
But it didn't last very long.
S&P right now trading at 2.5 times sales. It was 2.3 just before the dot-com crash in the early 2000s. It was much higher. It's much higher today than it was before the financial crisis. That was more a housing market bubble, though, and probably less of a stock asset bubble. And, stocks actually didn't go up that much between 2005 and 2007.
Yeah, that was
not like 2000 anyway.
2008 was more of a credit event, wouldn't you say?
Exactly.
Yeah.
So slightly different, but this is the highest price to sales ratio we've ever seen.
Yeah.
In the 100+ years of stock market trading.
Incredible, right?
All right, the Buffett indicator, by the way, Warren Buffett sold billions, tens of billions of Berkshire Hathaway in Q2.
And you know what he bought? He sold a bunch of shares of everything. And you know what he bought? He bought a bunch of short-term 2-year paper.
Treasuries.
Yeah, 2-year treasuries. Yeah.
And it could have something to do with the indicator that was named after him.
Could be. So it's basically this indicator compares the value of the stock market as a whole to the country's GDP. Yeah.
And to be fair, the stock market is a market cap weighted entity in this case. It's not equally weighted. So a few companies are going to contribute more to this.
Right.
And one could argue that, well, with the advent of AI and NVIDIA and revolutionary companies that have changed life as we know it, like Amazon, Apple, Google, et cetera, that this is justified. But I heard a lot of that in 1999 as well.
Yeah, I mean, and I mean, I clearly don't know, but it could be true today. It just takes longer, like 1999.
Yeah,
A lot of those things were true. They just weren't true immediately.
that's right. And Wall Street is a reward me next quarter, please,
Right.
because
Right.
this quarter I'm basically going to bake it into the price of the stock by bidding it up.
Right.
So the current level is also the highest level in history, and it's been pinned in this upper 100 range for quite some time now.
Yeah.
So TikTok. Okay, that's number 4. Number 5, this is a pretty easy one to understand, dividend yield.
Yeah. It just measures the annual dividend payment as a percentage of the stock price.
I remember the depths of the financial crisis as companies were cutting their dividend. By the way, Intel just cut their dividend recently.
Yeah, they've had a rough month.
I remember being able to purchase dividend paying stocks at 5 and 6%, even 7%. Great companies. And that was a sure indicator that the ones that were going to survive that horrible period, right after the government started writing checks, those companies rebounded extraordinarily well. So dividends can be a great indicator of a bottom, but they can also be a pretty telling indicator of a market top.
Yeah.
We were at, around a 1% yield in the S&P. Most of my trading career has been in a bull market, and the S&P dividend index has hung around 2.5-ish, 2.2%. But we're back to below 2 right now. So I think it's about 1.2 as of the close today.
Okay.
So this is half of the normal bull market level, and historically it's almost a third of what we typically think of as the median dividend price. And it's not like dividend stocks have gone up a ton either.
Right, because usually there's that trade-off where
Yeah.
where the if there's appreciation in price, you
That's
give
right.
back on dividend.
Yep.
Yeah.
Finally, this one's a little bit harder to quantify. And some would argue that earnings growth is the wrong metric. You got to really look at earnings, but I just like earnings growth, or you have to look at corporate profits, because, there's all sorts of other things that go into the net profitability of a corporation besides their earnings, right? There's their expenses, their depreciation, their whatever their debt service is. But this is still a good, kind of like another version of the price to sales ratio.
Basically, yeah, it compares the growth rate of earnings to the rise in the stock price, right? And there's a flaw with that I think is being exploited through buybacks, obviously, right?
Buyback season will be over by the end of, is it September?
First week in September, I think.
First week in September.
Most buybacks should be over, but it's a way to manipulate that a bit, right?
A lot argue that this most recent market move is because the buyback green light came back on for a month after earnings.
Yeah.
But anyway, so we are at kind of that we're pressing those levels in 2000 again. It's hard to quantify because between money printing and inflation, there is no absolute metric. I'm sure there's an index somewhere. I couldn't find it ahead of this, but I can give you some anecdotes. So for Q1 2024, start of the quarter, analyst consensus estimate was about 5, and we came in at 8% year-over-year earnings growth. Pretty good. Stock market, however, took that and swallowed it and returned 11% over the same period. So nearly 30% more. Actually, nearly 40% more. And then Q2, and of course, Q2 reporting is just about over, but there's still, I think, NVIDIA left. There's still some big names out there.
Yeah.
But the blended earnings growth rate, as we know it today, is 11.5. And that's definitely a high earnings growth rate, highest we've had in since the very first part of the beginning of the end of the pandemic, I guess, in 2021. And this was the big quarter. Estimates were around 8% or 9%, and they have beaten them so far. But year-over-year stock price performance has been 17.5%. So once again, significantly outpacing price appreciation, outpacing earnings growth. Now, that's not necessarily a problem, but you have to keep in mind about how we determine prices. It's earnings times multiple. So when the stock price grows more than the earnings, it means the multiple has to increase.
Mm-hmm.
So currently, and this is down significantly since the start of the quarter. For Q3, I think the expectations were 3.5% to 4%, and it looks like that, and that's a bit of a downward revision. I remember we went into the quarter it was 10%, so we are, and I think at some point in August it was 4.7, recently downgraded to under 4. And the stock market has corrected about 2.3% since we got these growth estimates, but clearly the net aggregate market performance is still ahead of earnings performance.
Yeah, clearly.
So we'll see. So I picked up the Qs here. I had the SPY, but something happened just before we got together. Let me see if I can make this a little bigger by eliminating our pretty faces
All right.
from the picture. So before I get into this, anything you want to say about the current stock market? We had that colossal drawdown. We broke through diagonal resistance. We reacquired what is the 40-day exponential moving average here. And we've had a couple of short-term topping patterns. Might be a little hard to see here, but there was a hanging man yesterday and then a bearish engulfing pattern today on a little above average volume today.
Yeah, I mean, I think, and I don't know if you show it in your charts or not, and I mentioned it before we hit the record button, is that there's just some really obvious divergences occurring on the major indices. So, RSI, the relative strength index, seems to be rolling over, making much lower highs.
I saw MACD rolling over, which is a momentum indicator.
So much lower highs relative to price. So
that's right.
It's definitely a sign of slowing momentum. And the rip your face off rally we saw, following the unwind of that carry trade, as they call it. I mean, man, you only know kind of in hindsight, but oftentimes bear market rallies are just like that.
Yep.
So I mean, remains to be seen, but it's worth noting.
Well, let me give you another data point that adds fuel to that thesis. And that's the color scheme you see here. Cheat Sheets is known for its tailwind score. And basically, when you get a tailwind score between 50 and 60, it's slightly bearish or neutral plus. Above 60 to around 85 is optimally bullish. Above 85, very bullish, but you could be closer to the end of the rally than the beginning, although you can be very bullish for months and months. It's a momentum score based largely on 10 technical metrics that we put together and baked a cake in a kind of a proprietary proportionality and created that model. So that's what I like to call the under the hood model. It's more substantial and it takes into account 10 factors. But for a quick glance, what I'd consider to be, if you're evaluating the car without looking under the hood at the engine, just see what the internal machinations are like. This is a cosmetic view of the market. So I guess in short, I think you joked at the beginning. You kind of had a caveman expression for how to interpret this.
Oh yeah, I was like lime green good, bright red bad.
Yep.
Yeah.
And that essentially is what it is. So the brighter the color, the more extreme in the direction of the color. So red is obviously bearish and green is very bullish. And within that, there's some metrics that drive that. Before I get into that, I'll explain them here. But you can see that we had this pullback that actually turned things red for a while. And we've pulled out of that swan dive. Price got above the 40-day moving average, but the line has not turned green yet. And that's really key, because if this were a rally that had some legs to it, it would last. Yeah. I mean, we would start to see at least a dark green color. All right, so I'm going to show you a couple of the charts. Okay. But let me get into kind of the specifics here. You'll recognize these for those of you who follow cheat sheets. Think of this as tailwind light. It's just a color scheme that goes along with tailwind. So bright green, as AA mentioned, very good. We need to have price above a rising 40-day exponential moving average. We need shake and money flow to be at that FOMO level of institutional accumulation. And this is where you're going to see the market falling down, is on money flow. Institutions, yes, sure, they're buying this rally, but mostly retailers have been piling in.
Yes, right.
And you'll see that by the lack of money flow.
Yep.
So in order for you to get a bright green indicator, you have to have money flow above 0.2. That's very bullish. And we also call that buying pressure on our cheat sheet tailwind modeling. Money flow and buying pressure are the same thing in terms of how we use them. And then the market forecast intermediate line has to be bullish or very bullish. The oscillator has to be above 50 and rising, or above 80. On cheat sheets, we dumb that down to bullish or very bullish. So all three of those conditions have to be met. And when they are, prices are likely to keep trending upward over the intermediate weeks to months time frame. Okay, very likely. Dark green is slightly lower standards. Money flow requirement, and we still have to have an uptrending intermediate trend. We have to be above a rising 40-period moving average. But money flow needs to be above only 0.1, and the market forecast oscillator now can be neutral plus or better. Okay. So if Chaikin money flow were still very bullish, but the market forecast indicator were only neutral plus, you'd get a darker green as opposed to a lime green. So both conditions that were necessary for bright green, even both of them would have to be met. Otherwise, we go to dark green. Make sense?
Yes.
All right. So yellow is the absence of a bullish or bearish rating, where the conditions are mixed. So I'm going to skip that one, and we'll leave it off at dark red and bright red. They're the exact opposite of the bullish and very bullish indicators. So price must be below a falling 40-day EMA, even though I haven't said that here.
Okay.
Chaikin money flow has to be lower than negative 0.1. So that's a bearish score on cheat sheets, buying pressure. Okay. And the market forecast intermediate line also needs to be neutral minus or worse. So below 80 and falling, or below 20 and moving in any direction when it gets that low.
Okay.
All right. And then bright red, very bearish, which is the condition where it's very likely prices will continue to fall precipitously. Prices below a downtrending 40-day EMA. Chaikin money flow is at what I'll call very aggressive levels of institutional liquidation, minus 0.2 or lower. And the market forecast intermediate line not only has to be falling, it has to be falling and below 50. So it's kind of like the RSI for a very specific weeks to months time frame. And that's very bearish. And so prices are likely to fall in those circumstances. So now you can start to look at a few other things, like I know this is going to set up a little bit of an argument here, but we had a big move in bonds, and then now we're having a bit of a consolidation because the market expects the Fed to lower interest rates. And of course, bond prices move proportionally to interest rates. Now notice that the TLT, which is the long end of the curve, has moved from essentially neutral, despite the uptrend that's been going on for a while, to only bullish right now. And of course, it looks like prices hit their head at a rough resistance level. And according to the metrics I've got here, the chances are better than not for at least slight price appreciation here, which means interest rates would fall. But that is sort of the consensus view right now. And I know AA, you feel strongly about this one.
Yeah, I do. And it totally is contrarian, and I acknowledge that. While I do obviously concede the Fed is going to cut interest rates, and likely it appears within the next couple of weeks at their next meeting, there's nothing in the rule book that says the long end of the curve has to follow the Fed funds rate lower. A phenomenon that in trading is called the bull steepener, where the long end of the curve, so the 10s and the 30s, can stay planted higher, and
by that you mean the rates, not the prices of the bonds. Correct.
The associated yield. Those yields can stay higher while the short end of the curve falls, thus steepening the curve. And to me, that seems more likely than not, for a couple of reasons. For one, because of the debt issuance that continues, that government continues to need funded at a higher and higher level. And secondly, in conjunction with that, is that the Treasury has their finger on this thing, controlling duration that they issue in new debt. So they can fill gaps on the long, if the long end falls too far, they can just push more debt there and increase supply, thus pushing up pushing down price, rising and pushing up yield. So I just feel really strongly in, the industry I'm in the mortgage space and the real estate space, everybody's already counting their chickens and their eggs for this upcoming refi boom. And I think that they're going to be disappointed.
And you can see a few times where bond prices have turtle headed above the 40 period moving average a few times. But the line, would either fail to turn green or turn green for just a few candles and then headed lower again. So your expectation here would be that maybe this is something you're probably not trying to time, but you feel like at least there's a bearish shot here to be taken against long 20-year treasuries.
Yeah. And 10-year, I have some bearish positions.
Yep. So your money is where your mouth is.
It is, absolutely.
Okay. And I'm not actually trading long duration treasuries. I'm still mostly in short-term stuff because it's still paying 5%, those 6-week Janet Yellen bonds she's using to buy the government's own debt. She's basically selling the short end to buy long-term debt because there aren't enough subscribers to that $11 trillion that we need to roll over.
Right. I mean, it's rare that the Treasury does buybacks in the way they're doing it. And I'll just add one other thing. You said you're buying the short end. I'm, long twos.
Me and Buffett.
Yeah. I mean, so if you're long the 2-year bond and short the 10-year bond in some, calculated way, 2-to-1 or something like that, however you calculate it, like that's a trade I'm involved in. I like that trade.
All right, let's do two more actually. So I pulled this one because I noticed a ship got attacked. It's been a while since we've had a major ship attack in the Red Sea. I pay attention to Zion on geopolitics, Peter Zion, who wrote the book, The End of the World is Just the Beginning.
I love Peter.
And one of the, as deglobalization rears its ugly head, one of the things that he forecast was that nation states and their proxies, in this case, Iran and its proxy group, would make regional shipping challenging. So getting global resources to fuel the global supply chain would be an issue. And obviously the one that's most concerning is oil. And while I don't think the Red Sea is actually a major oil transit hub, at least not compared to something like the Black Sea or the Straits of Hormuz, I think anytime we have an attack on shipping, that can be bearish for oil. And I was expecting to actually see, there's a bit of a candle today in the futures market after hours, but not what I would call dramatic. And I don't know if that speaks to the idea that the geopolitical risk is just being ignored, or is the economic weakness, which is day by day just becoming absolutely clear on a global basis, is that simply reflected in the price of oil?
Maybe it's some of all of those things.
Especially because with the expectation for Fed loosening to occur, we're really not seeing explosive moves at the long end of the curve. To your point on treasuries, we're not seeing exploding prices in commodities, though there are going to be some exceptions. Precious metals and industrial metals that are related to the devaluation of the dollar. We are seeing that, but we're not seeing it universally and across the board.
No. Yeah.
So economic activity being discounted, and that seems to be a bigger drag on things than funny money at this point, or the dollar devaluing. Okay, so now that's basically the and I think I had a gold chart, but we lost it in translation too. But gold just turned lime green.
Yeah, and it's breaking out a bit from a consolidation.
Yep.
Yeah.
So gold recently broke out from an all-time high, and then it's retracing. I think today it went down a couple of bucks, and it looks like it's going to do that. We like to call it throwback retest from a breakout line. But Cheat Sheet's data is very bullish on gold, and this is now what we consider to be the more under the hood look at the U.S. indexes, and obviously broader and less selective. Anything above 60 is bullish. Anything above 85 is very bullish. 50 to 60 is moderately bullish. And I like to look at things that are between 40 and 50 because while not all the metrics are there to reinforce a fully bullish position, if the leading indicators like buying pressure and the intermediate market forecast are, sometimes I'll take a shot at something in the 40s and 50s. But we're simply not seeing, well, I guess we are seeing a little bit of what I'll call anemic buying pressure on some of the large caps.
Mm-hmm.
So SPY and DIA turned neutral plus recently, but not what we call screamingly bullish, certainly not screamingly bullish to match the recent move.
Yeah, not at all.
Yeah.
Mm-mm.
So we're ever so slightly bullish on the SPY. But the other thing I'd like to point out on SPY, row 2, is factor 7. The long-term market forecast oscillator, which is not part of my what I'll call the tailwind light chart colors. Whenever we see a market forecast oscillator on the longest term, which is the months to a year or two time frame,
Mm-hmm.
whenever that is showing slight to increasing bearishness, that is a headwind against an intermediate trend. And what we typically find is that, yes, an intermediate trend can still happen, but where the average length is maybe 3 months, the max length is 9 months, or sometimes we'll get these egregiously long ones like we got recently, over a year. More often than not, intermediate trends end quickly, like a couple of weeks to a month. Month is typical.
Right.
And so the fact that the market forecast long-term is butting up against a very bullish intermediate forecast, factor 8, and a neutral plus only buying pressure, certainly doesn't say a crash is imminent. It just suggests that a breakout's going to be hard. We're not going to get a breakout like a knife through butter here.
Right. There's not and that's kind of, and going back to what I said at the beginning, that's what the RSIs are suggesting. Yep. The relative strength indicators is that there's just not a lot of momentum behind these big indexes right now.
The one thing that I think is a tell about the price of gold beyond its own technical metrics here and the combined tailwind score, the composite tailwind score at 78, is the dollar. Now we're using the ETF because we need to be able to measure volume and certain other things. So we're comparing index ETFs, and obviously these can be slightly different than the underlying index, but the dollar looks horrible.
Yeah.
And is that just rate expectations going lower? This feels like it's a lot of pressure on the dollar, namely
Mike,
our debt.
Mike, I don't know the answer, but my suspicion is similar to that of oil. It's probably a combination of a lot of things.
Yep. Typically, though, when we're scared of a recession, risk assets get liquidated and the price of the dollar short term tends to be bolstered. But we're not seeing that right now.
Mm-mm.
And we also would expect a weak dollar to translate into stronger Bitcoin. Now, that's a relatively recent currency. We don't totally have the correlations figured out, and it's probably my blind spot. I bought a little Ethereum recently and a little bit of Bitcoin on a downtrend, but it's I'm not doing any kind of cheat sheet trading. That's just a buy and hold investment for the long term. But I don't know. Have you seen much of a way of correlation between crypto and dollar?
Mike, I'm no crypto expert. I'll be the first one to admit it. But
neither one of us are.
What I have noticed, and I'm sorry, I don't really know. I haven't paid attention to it as it relates to the dollar. But what I have noticed over the last couple of years, I've paid attention to this, is that crypto seems to be a pretty reliable liquidity indicator for the markets overall.
So when people are swimming in cash and nowhere to put it, crypto gets a bid.
That's right. And when people are pulling money from markets, they're also pulling money from crypto.
Got it. So if we have a big stock sell-off here based on the overvaluation, crypto may be a home that money finds. And when the Fed, when and if the Fed starts up the printing presses again, crypto should have a home.
Yeah, and maybe if somebody wants to go look. So the Thursday and Friday before the carry trade unwind a few weeks ago.
That's the Japanese yen that was typically getting borrowed to buy U.S. stocks. The institution stopped doing that.
So I don't know if crypto played more of a role or not, but as an indicator, Crypto took a pretty big hit the couple days before that unwind really hit. So it was a little bit of a signal that there was liquidity was drying out in the market. Maybe something was happening under the surface. So as a liquidity indicator, I love crypto.
Yep. All right, we got one more, a couple more charts to share with you. This is a relative strength rank and trend report. I know this is a little small to read, but let me tell you what to pay attention to is the grading score on the far right. Most important thing is that normally we issue grades A, B, or C. I'm sorry, or watch closely. So on all of these major indexes, with the exception of gold, which earns a B grade, and a B is not a bad grade. It's a high passing grade. There's nothing else that's warrant a grade. And the reason for that is money flow on the equity indexes is neutral. So, and in some cases, like the IWC, which is microcaps, row 4, it's red, meaning under liquidation and actually fairly significant institutional liquidation, no grade. So the other thing that helps something earn a grade is that we need to see an average relative rank score in the top 50%. So this is literally grading on a curve here. So all of these indexes are pitted against each other. And if your rank relative to the other indexes shows up in the top 50% of the equity index ETFs that you're checking, then that's a prerequisite to getting a grade. The second part of that is that the average relative strength rank for the 10 to 60 day period, so the shorter, more recent time frame, has to be higher than the 3 to 6 month or the 120 day to 60 day trading day, which is roughly 3 to 6 calendar months, has to be higher. So we're seeing relative strength rank trending down on a lot of assets, with the exception of gold, where it's trending higher. And then it's just a degree of magnitude. So for example, if gold is in the top 50% in the what we call the sweet spot look back period, that's the intermediate time frame, 3 to 6 months, and the relative strength rank average in that 10 to 50 day look back period is in the top 33%, and money flow is above Chaikin money flow is above a 0.2 or higher, then gold would get an A grade. As of right now, it looks like we are literally 1/100th of a point away from an A grade for gold.
Got it.
So this pullback, to me, I'm going to be adding to my position tomorrow, unless we just have a hellacious sell-off. And I'll probably look at a momentum indicator like a MACD just to make sure I'm not being idiotic about it, because I am investing in gold, but I'm also trading some gold. And I think I want to add to my position tomorrow on this pullback.
You and I've talked and I've said it before. I've been into silver for a while, and it just isn't doing a thing.
Yep. Although it does have money flow, we're not seeing it on this chart, but I will do some macro reports over the weekend for subscribers.
Okay.
All right. And finally, we'll just now add to the index ETFs, or to some of the index ETFs, we'll add our major US sectors. And so once again, other than TLT, which in this chart, now remember, it's always graded on a curve. So in this chart, it earns a grade B based on its money flow, and then on its relative strength relative to these other index ETFs. It earns a B here. And then watch closely on XLY, which is interesting. And that is largely due to the relative strength rotation into XLY, which is, XLV, right? XLV. Healthcare. And we've been following this for a while. Now, we don't have a huge amount of money flow there yet, but the relative strength rank transition through the sweet spot, following through into the 50 to 10 day area, is legitimate. Not enough because of money flow to warrant a B or an A grade. But within that, and I sent this out to subscribers yesterday, you can look back, or to, I guess, what would be Wednesday's release. PPH, pharma, and biotech seem to be driving the healthcare sector right now. And we did some premium picks for our paid subscribers in the healthcare space, particularly in pharma yesterday.
Got it. Yeah, XLU seems to have had a bad 10 days after a relatively long run there.
And XLRE too. So the interest rate sensitive stuff,
yeah,
the stuff that's supposed to do better as the result of the Fed raising rates, has had a little bit of very short-term setback, but money flow still looks pretty good
Yeah.
on XLRE and XLU. And so we'll have to wait and see. But your interest rate thesis, at least for this week, seems to be playing out.
1 week.
Will AA be a broken clock, right like a broken clock twice? Are you the Nouriel Rabini of rates? All right, let's wrap things up. Thanks for watching the Unfair Advantage podcast. I'm going to try to do more of these. Please give us a thumbs up if you felt this was useful, or leave a comment telling us which parts of this presentation you liked and which were a snooze fest. Maybe it was all of it. You can get AA at localadvantagemortgage.com.
Yep.
You can get me at stockcheatsheets.substack.com or stockcheatsheets.com, also on Facebook and LinkedIn.
You can also find my blog at macrotomortgage.substack.com.
Thanks for watching, everyone. We'll see you again soon.
Thanks, Mike.